everybody. Welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thanks for joining us. So today we thought we'd talk a little bit about the only free lunch in the investment business, and that is diversification. And so for quite a long time, almost 12 or 15 years, diversification, all that it meant was just owning U.S. large cap growth stocks, and your portfolio did extraordinarily well. Having a diversified portfolio, which included international, small cap, mid cap, value, really underperformed those large cap growth stocks. But for the last, say, 18 or 20 months, diversification has really worked. So far in 2026, diversification is outperforming those U.S. large cap growth stocks. There was a long period of time when the Mag 7, all of these companies, the big tech companies like Facebook, Amazon, Google, NVIDIA, the market went up based on what those stocks were doing. And there was the thought out there, and Josh and I weren't sure that it wasn't true, that if those stocks didn't work, the overall market didn't work. Well, so far in 2026, those stocks actually have a negative year-to-date performance collectively, and the other 493 stocks in the S&P 500 are driving its performance. And so when we look at the landscape out there, it's great to see that we're seeing a broadening of the market, meaning those stocks aren't doing great, but the market itself is doing well. And we're seeing a reversal of that U.S. large cap growth trade. Value stocks are doing really well. So think of the old line blue chip names that are really boring businesses. Those stocks are doing well again. Small caps, so companies that are really small, are doing really well. Emerging markets and international is doing well. And value is certainly, like I said, outperforming growth. And so we are quite encouraged by our asset allocation, meaning the stocks that we own in your portfolios, and also the bonds. We're getting that right, as well as interest rates. Still, there's lots of volatility in the interest rate complex. But the important thing to remember is that diversification, which we preach all the time, is really working in 2026. We think that's going to be true going forward. And then, if we do have a rollover in the overall market, a la the late 90s, early 2000s, diversified portfolio did really well when you compare it to what the NASDAQ and the S&P 500 did. And we think we're seeing a lot of echoes of that market. So I guess the point of this is that diversification is working, and all of our clients, if you are a client of ours, are diversified and do own these asset classes, and so are doing well relative to the market this year, and we think that's going to be true going forward.
And I think one of the primary sources of optimism for us is that the biggest headwinds in particular asset classes are now not providing a catalyst for a sell-off. So for instance, the dollar has had pretty positive performance of late. International stocks have actually held in very well. There was a long period of time where they were very inversely correlated. You look to the small cap space, the fear of a rate increase would have previously sent small caps cratering off of a cliff. In spite of the market anticipating potentially a rate hike before the end of the year, small caps are continuing to see their outperformance. So those asset classes are shining despite the previous headwinds. And that tells us, and in combination I think with sort of the lack of highlight of performance, that there could be potentially a lot more money to flow into those asset classes. Retail investors aren't really particularly aware of the outperformance. It's not highlighted on financial news channels, and it's that next leg higher that comes when additional flow starts to enter the asset class. The other thing that we'll be watching throughout the summer, of course, is the Federal Reserve. The next policy meeting is until the latter half of this month, on the 28th and the 29th. It seems like the weakened jobs report is going to give the Fed sufficient predicate to not hike in the July meeting. All the central bankers across the world meet in Jackson Hole over in August. It's not a policy setting meeting, but it's there where you'll, I think, get Kevin Warsh continuing to articulate his vision for the new Federal Reserve. And then, of course, September is the first time a rate hike will conceivably be on the table. We'll get a lot of additional economic data between now and then. But Jackson Hole is really what's going to set the stage for the Federal Reserve's actions throughout the latter half of the year.
All right, if you have questions about your account or your situation or your client and you want to schedule a review meeting or a phone call, call us here at the office, 800-743-0988, or email either one of us, Josh or Tyler, at northwestquadrantwealth.com. That's it for this week. We'll see you in a couple weeks.